when we refer to apportionment under section 24J, this is probably the one section where it is a little bit different from what you've seen in a subject like management accounting when they refer to section 24J. Now basically what this refers to is it might mean that if your tax year, so this is the beginning and this is the end of your tax year, it might be that you enter into contracts or instruments that run for a different period than your tax year. So for example, in the red that you see over here, it begins and it ends in a different period of time. Now all that means is that you are only going to account for the interest that falls within your actual tax year period. The interest that falls outside of the tax year period, which I'm showing over there, that will be accounted for in a next tax year. Now all I want you to see for this point in time is that when we looked at the definition of an accrual amount, they told us that if we have to apportion it, we have to do it on a day-to-day basis. So if you look at the definition of accrual amount, it tells you over here that you have to accrue, or it will be apportioned on a day-to-day basis. Now, again, just to basically show you how this works, so here's an example. So what I want you to see is our tax year runs over here. So this is the beginning and this is the end of our tax year. Now it says X Limited has a 31 December year end and is the issuer in relation to a debenture. So obviously if you are issuing a debenture, you are the person who is going to be paying. The debenture has payments that are made every 4 months and it was entered into on the 1st of February of this year. So can you see our tax year starts? Let me just show it again here. Our tax year starts here in January and it ends in December. So this debenture makes payment every 4 months. So if we entered into it in February, we've got February, March, April, May. May is 4 months. So here you go. This is a period of 4 months. Right? Then June, July, August, September is the next 4 months. And then October, November, December, and January is the next 4 months. But what is now very important that you need to see here is that when we look at payments number 1, this payment, these 4 months, falls entirely within our tax year. So we will include 100% of this amount for section 24J. In this case, because we are paying it as a deduction. The same with payment number 2. This also falls within our tax year, so again, 100%. Will be deducted. But look at payment number 3. Only the period from 1 October until 31 December falls in our tax year. It's 3 months. Now that is an amount of, how many days is that? We've got October, November and December. 31 days, 30 days, 31 days. So that is 92 days. Okay, so and how much is it in total? Right, how much is it? It's also January is added there, 31. So 92 plus 31 days is 123 days in total. So payment 3 happens over 123 days. So what does it mean? If this interest, let's say, assume that the interest over here was 10,000 rands for that payment, what is it going to mean for us? It means that the portion that falls in our tax year is 10,000 times 92, which is the period in our tax year, over 123 days. And that is what falls in our tax year. The period, so I'm going to say in tax year, and the amount of 10,000 times 31, which is January, over 123, is in the next tax year. So basically, this is the most complicated they can make it by having you have to apportion it. And you will also see that in your lecture example. Great, and that is it for section 24J.